Today I'm going to show you 8 ETFs that have about 100 stocks or less, and I'm going to show how most of them actually beat the S&P 500 over time. I did a video about a year ago about 10 stocks versus the S&P 500, and I looked back about 10 years, and I basically made the assumption that you would pick the top 10 S&P 500 stocks each year and just hold the same exact stocks each year until the present time. And I looked at the returns, and I was surprised that even after a period of about 10 years, most of the 10 stocks had a higher return with less volatility than just holding the S&P 500. I got the idea of looking for ETFs that have roughly 100 stocks or less, and I found 8 of them. I found 8 ETFs that have anywhere from 53 stocks up to 123 stocks. Most of them are less than 100. There's only one that's 123 that I threw in there. And they're from all different indexes. They range in assets from about $2 billion in market cap to $288 billion. It's a variety of indexes. So let's look at the 5-year. If we look at the 5-year here, if we look right here at the white line, this is the Vanguard S&P 500 fund. It has a 102% return after 5 years. Now with the dividends reinvested, it's 102% return. So basically out of all these ETFs, only 2 did worse over a 5-year period. And that's Charles Schwab U.S. Dividend Equity ETF, SCHD. It only did 78.39%. It's been struggling. It's been at the bottom. For this whole period, it's kind of been at the bottom. You can see here in the orange. But there has been one that's even worse, MTUM. This is the one that had the most amount of stocks, 123 stocks. I threw this one on at the end. And this one has a 0.15% fee. It's the SR Variant Index, S&P 500 Momentum. It has $10 billion in market cap, roughly. But if we look at all the other ones, they've all done better than the S&P 500 while holding fewer stocks. So if we start from the top one, XLK, it has a 185% return. XLK has only 67 stocks. It was started in 1998. It has a fairly low 0.09% fee. And the index that it covers is the Select Sector Index, and it has $69 billion in assets. I was going to try to add QQQM, which has a lower 0.15% expense ratio, which is basically the same thing as QQQ, but QQQM has not been around as long, so I added QQQ, which has a 0.2% expense ratio. And this is basically the NASDAQ 100 index. 101 stocks, started in 1999, 0.2% expense ratio, $288 billion in market cap. So it's the largest out of all these. Now the next one is the only one from Vanguard. It's the Vanguard Mega Cap Growth Index, MGK. It has a 142% return, 71 stocks, started in 2007, and it only has 0.07% expense ratio. And it's got $22 billion in market cap. So despite only having 71 stocks, it did pretty well. The next one is SPMO. It has 101 stocks. It started in 2015. It has a 0.13% expense ratio. It's the S&P 500 Momentum Index. It has $2 billion in market cap. Okay, now the next one is one that I selected called XLG. It only has 53 stocks, so it has the least amount of stocks. It was founded in 2005, has a 0.2% expense ratio, and it covers the S&P 500 Top 50 Index, and it has about $6 billion in assets. And the next one is SPHQ. It has 102 stocks. It was started in 2005, 0.15% net expense ratio, and it covers the S&P 500 Quality Index, and it has about $11 billion in market cap. Let's look at the 1 year now. If we switch to the 1 year, SPMO is the 1 year performance winner at 51%. And the next one is MTUM, and then Vanguard's MGK. You can see the Vanguard is way down here. So tech has really been taking off the last year. Most of these are heavily invested in tech. That's why you see so many doing better than the Vanguard S&P 500. And the only one that's really doing worse is the Schwab Dividend Equity ETF, SCHD. Okay, let's go back and look at maybe a 3-year. So we're going to change this to like 2021. Now, if we look at the 3-year, Vanguard S&P 500 is sort of middle of the road at around 32% return. And we still have XLK, XLG, and a bunch of them above. And then the Schwab US Dividend Equity ETF is below, and MTUM is the worst performing one so far. Now let's go back around 10 years. I think we can go back. We're going to go back around 9 years because one of them is from 2015. So instead of we'll do around 2015. Okay, so now this is roughly a 9-year time span. And if we look, XLK is also the winner. And if we look here, starting from around 2022 on, it really went crazy as far as the price, just because it holds a lot of Nvidia, and Nvidia went crazy. And I think QQQ also may have a lot of Nvidia. So I think that's the main reason. But if we look at this is the 9-year return. So 513% with dividends reinvested for XLK. The next one is QQQ. We have the Vanguard MGK, the Mega Cap Fund, 325% return. Then SPMO, and we only have 2. We've got 2 that did worse than the S&P 500. That's the Schwab Dividend Equity ETF and MTUM. And if we go back a little bit further, if we don't trust the most recent results and we want to look back a little bit further and see if it's changed, XLK is still the top one. If we look at the colors here, they don't really cross over for the top ones. So the top 3, it goes all the way back, I think, to about even back here, back to 2019. It looks like we do have a little bit of a crossover here. MTUM did slightly better than the Vanguard MGK, the Mega Cap Fund, but then the Mega Cap catches up. Okay, so let's look at XLK, the best performer. Now, XLK is a technology ETF. It says estimated weight of XLK components, roughly 31% of the S&P 500. Only 67 holdings, 0.09% expense ratio. And if we look at the holdings, there's over 40% in just 2 stocks, Microsoft and Nvidia, some of the best performers in the last couple years because of the AI stuff. So it's doing well now that these stocks are doing well. But if these stocks start to do poorly, the performance is going to tank, and it's going to be probably the worst performer. Apple's also about 5%, and it's performed well. And you've got a lot of tech here. So Adobe, Cisco, just a lot of tech, and 67 stocks. Okay, let's look at the next one. QQQ, which is the NASDAQ 100, to the 3rd best performer, the Vanguard Mega Cap Growth Fund. We can see here that QQQ did better. Pretty much when we go all the way back from 2008, it's been doing better most of the time, even better than Vanguard, because the Vanguard Mega Cap is a lot less tech, and tech seems to do better over time. So if we look at QQQ has roughly 9% Apple, about 8.3% Microsoft, about 7.6% Nvidia, Broadcom, Amazon, Meta, Tesla, all big tech. Now, if we look at the Vanguard Mega Cap Growth ETF, it has sizable investments in Apple, 13.5%, Microsoft 13.07%, Nvidia 11.3%. And so I think that's the reason for some of the good performance. Now we start going further down. It's not all tech. They have Eli Lilly, Visa, MasterCard. It is heavily weighted towards tech, it seems like, though. I mean, they have Disney, though, S&P 500 company, TJ Maxx. So you've got a lot of large companies, but less tech in the Mega Cap Growth ETF. Okay, the next one is the Invesco S&P 500 Momentum ETF. It has a huge percentage in Nvidia, 12% roughly. And I'm not sure when they picked this since it's momentum. Maybe after it started going up, they selected it because it wasn't the best performer. They have 9.79% Apple, Meta 8.5%, Microsoft 8.2%, Apple, Broadcom. But they do have some non-tech stocks like Eli Lilly, Berkshire Hathaway, Costco, JP Morgan, Walmart, IBM. We look at XLG on the right here, the Invesco S&P 500 Top 50 ETF. This one has the least amount of stocks, only 53 stocks. It has a large 11.5% position in Apple, 11.5% in Microsoft, 10.5% in Nvidia, 6% Amazon. But they also have Eli Lilly, United Health, Exxon, Visa, Procter & Gamble, Johnson & Johnson. Okay, the next one, probably the worst two performers out of all these is the Schwab U.S. Dividend Equity ETF. If we look at the holdings with Schwab U.S. Dividend Equity ETF, it's probably the most different out of all of these. It has basically no tech companies near the top. It's got a defense company, Lockheed Martin, this one here, ABBV, I believe this is a pharmaceutical, Home Depot, BlackRock, Coca-Cola, Cisco, Amgen, Verizon. So I think this is the reason for their poor performance, because they're just not in the right category right now. Maybe if the tech sector crashes, this will probably start doing well. Okay, the next one is the iShares MSCI US Momentum Factor ETF. It's another momentum one. It has a pretty conservative, now MTUM has 123 stocks, so it's got the most out of all of them. It has a pretty conservative weighting. It doesn't have too much at the top. It's got Facebook, Meta has 4.92%, Eli Lilly about 5%, Broadcom 5%, Amazon, JP Morgan, Costco, Walmart, General Electric. We have another one called the SPHQ, 102 stocks, started in 2005. It is the Invesco Quality ETF. If we look at the top holdings, just like the other one we looked at, it's very conservative, 5.3%, Johnson & Johnson, Broadcom 5%, MasterCard 5%, Visa 5%, Apple. So you see that the tech stocks are further down, and that's probably why the performance wasn't at the very top. Now I don't see Nvidia at the top at all on this page, not even on the first page, which is unusual. Now if we look at the standard S&P 500, Vanguard S&P 500 ETF, VOO, which I'm sure most people are familiar with, it has 7% Apple, 6.7% Microsoft, Nvidia 6.2%, roughly 3.5% Amazon, Meta. You've got a lot of tech in the S&P 500, but you also have a lot of stocks. But you see that Nvidia is not as heavily weighted as some of the others, and that's why I think the performance is a little bit worse than some of the others. Now, unfortunately, I don't think we found the holy grail for the best performance is just buying the fewest amount of shares. I think I'm on to something a little bit, but most of this is the result of, most of this performance is basically due to the top performers being the tech companies and it being heavily weighted towards tech, and very few shares of the non-tech companies or the slower growth ones. And so I think that's the reason for the great performance, but this could easily change if the AI stuff falls out of favor. Like I said, this one could really, really tank. If you want to see just how well companies like Microsoft, Apple, and Nvidia did, I'm going to actually add these here, and you're going to see how well they did. Okay, so I just added Apple. Now this is roughly the 9-year period. So we look here, even greater than XLK is Apple. Apple had a 768% return. That's including dividends. Now when we add Nvidia, I'm going to have to remove Nvidia because it skews everything so much. 20,000% return in 9 years. Can you imagine that? And you look since 2003, just look how crazy it's gone. So I'm going to have to remove this one, unfortunately, because it's messing up the chart here. Okay, now I added Microsoft. You can see Microsoft here in purple. Microsoft did even better than Apple at 1,028% return. So if you invested in any of these, since these ETFs that have a greater percentage of these stocks, that's why they have such great returns. That's why XLK has done so much better than some of the others. Now, even Tesla, I'm going to throw Tesla, and it's probably going to throw up the chart out. Also, Tesla, 1,225% return over the 9-year period. I'll put a link in the description to all of the ticker symbols for the ETF shown in this video. If you like this video, please give it a thumbs up and subscribe. Have a good one. Okay, for fun, let's add the ProShares leveraged ETFs, the 2 times Ultra QQQ and the 3 times Ultra Pro QQQ. Okay, now we see that the 9-year for QLD, the leveraged ETF, had an even greater percentage than Microsoft at 846%. Now let's add TQQQ. Now we have TQQQ, the 3 times NASDAQ 100 ETF. It had a 1,267% return in 9 years. Pretty impressive, and you can see the huge swings in the price because it's leveraged.